Good afternoon, ladies and gentlemen. Welcome to the 12th KIEP-IMF Joint Conference. My name is Halin. I am from the KIEP side. Today's joint conference will cover the 2023 World Economic Outlook, Suppressed Recovery in the midst of the tightening and fragmentation. It will be composed of 3 sessions. We will begin with the opening session by the remarks from the president of the KIEP, Dr. Kim Jong. And the 2 sessions will follow. The session 1 will be about the 2023 World and Asia Economic Outlook, and the following session will be covering business cycle and firm activities. After the very last session, there will be a panel discussion about the topics that will be covered in the entire conference, so please stay tuned until the end of the conference. So I would like to welcome Dr. Kim Jong from the Korea Institute for International Economic Policy. Please welcome him with a great and warm round of applause. Thank you.
Good afternoon, ladies and gentlemen, and honorable guests. It's my great pleasure to welcome you all. And thank you very much for joining our lunch. Yes, I believe we had enjoyable dialogue. First, I'd like to express my sincere gratitude to the session chairs, speakers, and discussants for participating in the 12th KIEP-IMF Joint Conference. Special thanks goes to Dr. Seo, Iji-Soo, and Dr. Alexander Kopstek, economist at the IMF's Asia Pacific Department, for the extensive efforts in making this joint conference possible. The world economy is in a shaky state following the Russia-Ukraine war, which broke out just as the world was adapting to the COVID-19 pandemic. It wasn't long before we understood the significance of supply chains, but as the segmentation of the global supply chain continues, we are confronted with higher prices. Resources, notably raw materials, are increasingly being used as weapons, driving up the cost of goods and services through the economy and causing inflation to rise. It'll be some time before a period of low prices and low interest rate will return, as expectations for inflation continue to be high as well. The world economy is anticipated to expand by 3.1% this year and 2.4% next year, according to my institution KIEP's 2023 World Economic Outlook. From the 3.6% prediction put forth in May, the growth rate for next year was lowered by 1.2 percentage points. Global economic damage is mounting as a result of the protracted Russian-Ukraine situation. Because of the region's extensive economic and commercial ties to Russia, which is subject to sanctions, economic growth rates are predicted to slow or even reverse in Europe in 2023. At this point, I'd like to argue that suppressed recovery amid the tightening and fragmentation is a proper description of today's conference. The fragmentation of the global supply chain, brought about by the strategic struggle between the United States and China, is impeding global economic growth. In addition to monetary tightening brought on by inflation, the resulting fiscal burden and economic sanctions against Russia, 3 key risk elements apply in this situation: interest rate hikes and the private debt burden, a dilemma in fiscal policies, and worsening geopolitical risk. In my opinion, the ability of the governments and the private sectors to take on new projects is severely constrained from an economic standpoint, necessitating a novel strategy. This year has been much changed in international conditions. In light of the digital and green transition, it's been a landmark year for each nation's industrial policy to respond to geopolitical tensions. Beyond the fall in real income, which is adding difficulties to living costs, global inflation has risen to its highest level in 40 years. But long-term issues have not yet emerged. A proper policy mix must be found, and international cooperation is inevitable. In session 1, we'll look at the world economic outlook in 2023 and challenges in the Asian region. In session 2, we will explore the relations between global business cycle and firm-level dynamics during the COVID-19 era. The year 2023 will be a challenge for the world economy, but we'll look forward to confronting the crisis as an opportunity, if possible. Again, I'd like to thank all the participants and the audience for being here with us today. Thank you very much. 감사합니다.
Now we will move.
네, 그러면 제1세션 바로 시작하도록 하겠습니다. 본 세션에서는 세계 그리고 아시아 경제 전망에 대해서 발표를 듣겠습니다. 우선 시작에 앞서서 고려대학교 경제학과의 김진일 교수님을 사회로 모시도록
Thank you, President Kim. So this is the, I think it was told, 12th KIEP-IMF Joint Conference. I returned to Korea in 2010, so among the 12 ones, I don't know how many times I participate, but this is certainly one of the few meetings I participated multiple times. I would say, if I guess, maybe 6 times out of 12, I believe. So I look forward to this year's program again, and be happy to chair the first session, titled 2023 World and Asia Economic Outlook. So we'll have 2 papers or 2 presentations. The first presentation will be by the KIEP, Dr. Sang Ha-yoon on my right, who is the head of the International Macro Team. And then he was the lead author, I believe, of this 2023 World Economic Outlook. And the second presentation will be done by Dr. Lee-si Seo, who is an economist in the IMF Asia Pacific Department, and also he served as an economist in the money and capital markets. So I'm sure you have read the Global Financial Stability Report many times, and he has contributed several times to that. So during the presentation, each of which will present consists of, say, 20-25 minutes. The other 2 people will sit down, and then after both presentations, we'll have 10 to 20 minutes of the Q&A. Okay, so Dr. Yoon, please.
Hello, everyone. My name is Sang Ha-yoon, head of International Macroeconomics team at Korea Institute for International Economic Policy. I'm happy to have you all here. During 20 to 25 minutes, let me present World Economic Outlook, which was published on November 10th by KIEP. Of course, this work is not my own, and this work is jointly done with Economic Outlook team at KIEP, led by Dr. Sung-bae An over there. And the contents will be the overview of the World Economic Outlook, an outlook for major countries, and some implications including policy ones. The world economy is expected to grow 3.1% in 2022 and then 2.4% in 2023. Looking at the 2023 growth forecast by country or by region, the US will record 0.6%, the Euro area 0%, Japan 1.5%, China 4.8%, India 5.6%, ASEAN 5 countries 4.9%, Russia negative 2.5%, and Brazil will be 0.6%. Now, facing the negative impact of the prolonged Russia-Ukraine crisis, monetary tightening in major countries to deal with global inflation will slow the growth rates of many countries. This 2023 World Economic Outlook is based on the following assumptions. First, additional health crises such as COVID-19 will not have a devastating impact on the economy. And second one is that the monetary policies of major countries, such as the United States, will remain hawkish until the first half of next year. Third, the current state of the Russia-Ukraine war will remain intact for the time being. And behind the scenes, negotiations are underway. Fourth, there's no sharp change in investors' risk aversion, and rapid capital transfer from emerging countries to developed countries is unlikely. Fifth, China's economic growth rate is within the target range of the Chinese government, but set somewhat lower. Sixth, the strong dollar is maintained for the time being. And finally, the average annual oil price based on WTI in 2023 is around $91.6. However, there is a possibility of realization of risk factors such as which will be mentioned later. Looking at a 3-year growth path from 2021 to 2023, the growth rate is slowing significantly in most regions. Of course, the high growth rate in 2021 reflects the base effect of the economic recession caused by the COVID-19 pandemic in 2020. In case of the 5 ASEAN countries, the impact of Delta mutations in the second half last year was significant, so we can see recovery from last year. Let me talk about the forecast updates from May to November. In this picture, the blue dotted line is the outlook which was done in May, and the solid red line is the recent one. Forecasts for 2022 and 2023 are shown by region. And according to the graph, we can see that we have lowered the growth rate significantly for most of the regions, mainly because of the Russia-Ukraine war, which started in February 2022, and monetary tightening to deal with high inflation. This situation has acted as a downward pressure in most areas, and the intensity varies from region to region. A couple of exceptions are Russia and Brazil. For Russia, higher number this year than May reflects the difficulty of international cooperation for sanctions. For Brazil, they enjoyed higher oil price and commodity prices this year. When we recall the announcement of the 2022 World Economic Outlook in November last year, the policy capacity of the advanced countries was expected to lead global growth this year. But the situation has changed a lot. Now our attention moved to deal with the war and rapid inflation from long-term green and IT investments. This is the change in the forecast of major institutions. From the end of last year to the present, the growth forecast has been significantly lowered. This indicates that the basic assumptions of the outlook have been broken over and over again. On the right is the forecast for 2023. The KIEP forecast is located halfway between the IMF forecast released in October and the OECD forecast released in September. Now let me present keywords and risk factors for global growth. The keyword that penetrates the global economy this time is the suppressed recovery amid tightening and fragmentation. The forecast we have presented so far implied these keywords. As for tightening, we need to be careful about the unintended negative effects of the policy due to the pressures of monetary tightening caused by the global inflation and the constraints of additional fiscal capacity after implementing massive fiscal spending due to the COVID-19 pandemic. On the other hand, regarding the fragmentation, international cooperation is fragmented as the supply chain segmentation, as the global supply chain segmentation, which was slowly progressing due to the COVID-19 pandemic and the US-China strategic competition, coincides with the geopolitical change in Russia-Ukraine crisis. This is why conflicts are expressed in the G7, G20, and the United Nations Security Council. For a quick and short-term economic recovery, expansionary policies and international cooperation must work smoothly, and the recovery is being suppressed and delayed due to the restrictions on these attempts. As economic problems combine with security problems, it is becoming more difficult to find a solution. The 3 related risk factors are followed. The first one is a sharp rise in interest rates and increasing private debt burden. The massive liquidity released to overcome the COVID-19 crisis flowed into the asset market, expanding the debt of households and companies as well as the government. The problem is that the pace of reverting monetary easing is too fast and intense compared to the time of global financial crisis, and an economic downturn appears as it overlaps with supply-side factors. If combating inflation takes longer than expected, concerns about adverse asset effects, increased difficulties for individuals and marginal companies, and financial crunch could increase. The second one is the dilemma of fiscal policy. During the COVID-19 pandemic, major countries increased fiscal spending faster compared to the trend to respond to the health and economic crisis. Today, the governments are often constrained by budget constraints with huge additional spending and higher interest rates. Fiscal soundness is important, but the global economic situation is very complicated. The recent move by the British government shows the sensitivity of financial markets. Though intended to boost long-term growth, an unagreed announcement of expansionary fiscal policy could go against market expectations and spread quickly to a sense of crisis. The third one is geopolitical risks such as Russia-Ukraine crisis and US-China strategic competition. The era of globalization over the past 30 years, which began with China's accession to WTO and the collapse of the former communist countries, is becoming to an end, and a new era of disconnection and competition between blocs is coming. China's cross-strait problems and the recent threat from North Korea can also spread to global risks, which requires special attention. As a reference, we presented the Great Transformation here in November last year, and as a keyword in May, extreme uncertainty and recovering path during policy transition period. Global inflation continues around Europe and United States and around the world as it is shifting to core price pressure. We still have tight labor market and solid retail sales in the United States, in addition to bottlenecks in supply chain. The situation in Europe does not seem to be getting better until now. We expect that the global inflation will be eased during next year, mainly due to the aggressive monetary policy and subsequent decreasing demand. And these tables show how many times and how fast many countries have increased policy rates as a reference. For a long-term government interest rate, long-term bond interest rate, throughout the year, we have seen the rapid increase in the rate due to the inflationary pressure and Fed tightening. Long-term government bond rates expected to rise until early 2023 as tightening path in major advanced economies continue, but will decline gradually after economic slowdown and easing of inflation. We expect the US dollar will be strong at least until the first half of 2023, mainly because of hawkish monetary policy, preference for safe assets, rising raw material prices due to the war, and high uncertainty. And recent Korean won per US dollar dropped significantly, but because South Korean economy is heavily dependent on external factors, which are unstable for the time being, it seems that there exists a lower bound for the exchange rate. Even though the demand for the oil has slowed down and the oil price has dropped relative to the peak in early 2022, possible supply cut or reluctance to increase the production by OPEC+, who wants to maintain the specific price range which gives higher profit for them, will cause the upward pressure. Also, the demand substitution from LNG to oil in Europe gives the upward pressure in demand side. Now let's look at the outlook for major countries. For the US economy, we'll lower the growth rate by 1.6 percentage point from 2.2% in May to 0.6% this time for 2023. The inflation and interest rate burdens are expected to dampen economic activities in the private sector and limit fiscal policy. The US Fed is showing a willingness to control prices, even if it tolerates the economic slowdown. So the high interest rate trend is not expected to shift easily. In addition, as policy restrictions due to the political process become more complicated after the midterm elections, it is difficult to implement new large-scale fiscal policies. The euro area has been drastically lowered from 2.4% in May to 0% in November. The prolonged Russia-Ukraine crisis is expected to directly affect the energy supply and demand. In addition, the fiscal burden is increasing as major European countries seek countermeasures against the supply chain disruptions, which additional room limited along with the trend of interest rate hikes. Now, let me talk about Japan. For Japan, we have lowered only 0.1 percentage point from 1.6% in May to 1.5% in November for 2023 outlook. While it is difficult to expect export expansion due to the possible global economic slowdown, it is expected to continue low growth centered on domestic demand thanks to high saving rates of households and corporate profits. It is expected to maintain its expansionary monetary policy stance until the new governor of the Bank of Japan is appointed in April 2023. Inflationary pressure is slowly rising, but the core CPI is still in the 1% range. Regarding China, we have downgraded 0.5 percentage point from 5.3% in May to 4.8% in November. The economy is expected to recover with a possible containment of COVID-19 in China and the support of the economy through active monetary fiscal policies after 20th National Congress of the Chinese Communist Party. However, internal and external Chinese economic uncertainties are very high, such as falling real estate investments and related risks, and the possibility of a reproliferation of COVID-19 in China, and intensifying US-China conflicts, and prolonged Russia-Ukraine crisis. As China's fiscal income continues to decline and monetary policy capacity continues to weaken due to the US interest rate hikes, uncertainties over the effects of the economic stimulus measures in 2023 are also high. We cut 0.9 percentage points from 6.5% to 5.6% for India for 2023. Foreign direct investment is on the rise thanks to the Indian government's steady efforts to improve the investment environment and search for the investment destinations other than China. But external conditions such as high inflation, again, monetary tightening in major countries, and geopolitical instability are the downside factors. For Russia, it is hard to forecast for the Russian economy because we have little official numbers nowadays. But we cut 2.2 percentage point from negative 0.3% to negative 2.5%. This is mainly because the effect of prolonged war and the strengthened sanctions from Western countries. And lastly, Brazil is expected to grow 0.6%. Rising raw material prices have a positive impact on exports, but the accumulation of fiscal deficits and a contraction in investment and consumption due to interest rate hikes will affect negatively. Former President Lula won the recent presidential elections, which is expected to improve gradually in environmental and fiscal policy following the centrist pledge. And I'll summarize by giving you some implications of today's presentation. The first one is that we have to think of the rapid contraction of liquidity, which will harm the global economy. We have actually little time for households and firms to just prepare for the interest rate change. And there's a possibility of bankruptcy of marginal companies and households in addition to high volatility of asset markets. So the government or fiscal policy should have a role in dealing with these problems, even if the fiscal space is very limited. The second one is the negative effect of the permanent change in GVC. We are actually giving up the cost effectiveness of GVC that we have enjoyed during the last 30 years. Instead, we want to earn security and stability. By earning security and stability, we may confront mid-price level era. Now, reorganizing the production network and creating blocks will have significant effects on production, consumption, and price levels. It also may decrease the size of the markets that firms can access easily. The final one is that fiscal policy is still needed or government policy is still needed, even under the limited resources, which will promote the reallocation of resources from unproductive to productive units and promote and support the newly growing industries and combining new technologies into traditional ones, such as deep learning or AI-intensive technology. And the third one is about the IT and green tech-driven investment still needed for sustainable long-term growth. And this is the end of my presentation, and thank you very much.
Good afternoon, everyone. My name is EG Xu. I'm from the Asia Pacific Department of the IMF. And thank you very much for inviting us to present the latest Asia Pacific Regional Economic Outlook that we published last month. So I will focus on the Asian Pacific region. So let me first begin with a brief overview of Asia Pacific recent developments. So the Asia Pacific region entered 2022 with some resilience. And the region, except for China, largely brushed off a wave of Omicron infections with minimal delay to the reopening. And this allowed a number of countries to reopen the border to the foreign visitors, foreign investors, and also allow the countries to boost the industrial productions and domestic demand. And all these factors contributed to the better than expected growth in the first quarter of 2022, although the growth rate in that quarter was still a little bit negative. And the growth momentum continued in the second quarter of 2022, although the region is facing the downward pressure because of China's slowdown. In China, the zero COVID policy has led to strict lockdown measures in a number of major cities, which disrupted the domestic consumption demand and also the supply chain. So in the second quarter, the growth rate of China is reduced to just 0.4% year-on-year, which is also causing the disruptions to other neighboring countries, including Japan and Korea. So although there's a contraction in the trade volume from China, the region as a whole for the Asian Pacific was performing well in the first half of 2022, which is supported by the strong external demand from Europe and the US. But in the very recent data, based on the high-frequency indicators such as PMI, we see some weakening of the manufacturing sector as well as the service sector in Asia Pacific. On the inflation pressure has been proved to be more persistent than people anticipated. So as you know, in 2021, most of the period in 2021, the Asia Pacific has relatively moderate inflation. And when the Asian Pacific is entering 2022, the inflation picked up because of the rising commodity price, and also the output gap is closing. But still, the headline inflation in Asia Pacific is relatively lower than the rest of the world. The increase in the headline inflation that we observed this year was driven mainly by
the increased food price, especially in the emerging market in Asia, but also driven by the rising core inflation because the output gap is closing. And we also see the exchange rate is depreciating in Asia, which is also contributing or passing through to the core inflation in Asia-Pacific region. But of course, there's some heterogeneities across different countries or economies based on each economy's trading partners' currency depreciations. So now let me turn to the three headwinds, because in our regional economic outlook, we have this title, Sailing into Headwinds. And let me break down these three headwinds for you in the next few slides. So the first headwind is the tightening of the global financial conditions. We see that in the US, in the euro area, the central banks are tightening the monetary policy very aggressively because they're trying to tackle the rising inflation pressure domestically. And although the latest inflation number that's coming out of US is relatively moderate, but the market is still expecting the Asia-Pacific country, the market is still expecting the US will continue to tighten the monetary policy stance until 2023. And similarly, for the euro area, the market is also expecting the ECB will tighten the monetary policy stance more aggressively than previously anticipated. And the tightening of the global financial conditions will translate into the tightening of the regional financial conditions in Asia-Pacific. So if you look across the countries in Asia-Pacific, specifically on the local currency sovereign yields, and you can notice that the sovereign yields in Asian countries, especially the emerging market Asian countries, have risen substantially since the minimum in the pandemic. But the silver lining is that in Asia-Pacific countries, particularly emerging market countries, the level of the sovereign yields is still relatively similar as those countries have experienced before the pandemic. But if you look at the capital outflows coming out of the Asian-Pacific countries, the capital outflow is as large as what the region has experienced during the previous stress periods, including the taper tension, including the onset of the COVID crisis. But the capital outflow is not generalized, it's only limited to a number of economies in the Asian-Pacific region. The second headwind that we have in the report is the war in Ukraine. So the war has led to the spike in the commodity prices, and this will put the pressure on Asia's net exporters' current account. And we see that because of the terms of trade shock in the Asian-Pacific countries, and that explains the depreciation of the currency in the first few months after the war. So we initially thought that the war will affect the Asian-Pacific countries because of the weaker external demand from the US and Europe, but the fact is the war is affecting the Asian-Pacific region because of the increase in the headline inflation. But very recently, we see that the war is also affecting the external demand because the export orders that's coming from the US and Europe is decreasing, is weakening. The third headwind is the sharp and uncharacteristic slowdown in China. So in the latest World Economic Outlook that we published last month, we marked down China's growth forecast for this year to 2.3%. And this downgrade of the growth for China reflects two factors. First is the strict lockdown measures in the major cities that disrupt the supply chain and also the domestic consumption. And the second factor is the deepening of the property sector in China, because we know that the property sector is actually a very important component of China's GDP. At the same time, the property sector is very closely linked to the financial sector, which will pose a financial stability risk. So these two factors shape the outlook for China. So that's why we downgraded China's growth number to 3.2%, which is almost the second lowest growth number for China since 1997. So with all these three different headwinds, and that shapes the outlook for Asia Pacific. So this table shows the growth forecast, the latest growth forecast in the World Economic Outlook. And if you look at the second column of this table, we downgrade the growth of Asia by 0.9% for 2022 and by 0.8% for 2023. So the growth rate for Asia is 4.4% for 2022 and 4.3% for 2023. And for inflation, we also revised up the inflation forecast. So in Asia-Pacific regions, although we revised up the inflation forecast, but we still expect that the inflation level is much lower than what other regions are experiencing. So the rise in the inflation, of course, that's partly driven by the rise in the core inflation. And we see that in Asia-Pacific countries, except for China and Japan, the core inflation has been rising above the central bank targets. So that's why for these countries, we see the central banks have been tightening the monetary policy stance in order to bring the core inflation back to the target. So far I presented a baseline outlook for Asian Pacific, and now let me move on to the risk or the downside risk to the outlook. So in the regional economic outlook, we have these three different headwinds for Asia. And we also presented a downside scenario in which we mimic a situation of a perfect storm of these three different downside scenarios, which includes a deeper slowdown in China, the global recession, and the tightened financial conditions. So with all these three downside risks, a combination of these three headwinds, and the growth rate for the region is expected to be additional 1 percentage point lower. And of course, we also see some heterogeneities across the countries, depending on each country's exposure to these three different downsides, different headwinds. So in the medium to long term, we are also worried by these geo-economic fragmentations. As you can see from the first chart, the trade-related uncertainty index spiked during the China-US trade war and also during the Russian invasion of the Ukraine. And also, we have seen an increasing number of the trade restrictions that has been put in place in the whole world, which is particularly the case for those trade restrictions linked to the energy sector and the high-tech sectors. And we did a simulation in our report, and our finding is that Asian Pacific countries could face an even larger negative impact on growth with this trend of the fragmentations. So now let me narrow down to two largest countries in the region, China and Japan, which are also closely related to Korea. So for China, as I just mentioned, we downgrade the growth for this year and next year, which reflects two factors, the lockdown measures and also the deepening of the property sector turmoil. But there are two additional things I also want to say. First, we also priced in the fiscal support and monetary easing that the authority have been implementing. But the positive effect because of this fiscal and monetary support is only around 0.6% for this year, which is far less for compensating the negative shock. And the second thing I want to say is that for China, we are expecting next year the lockdown measures, the zero COVID strategies will be lifted or at least partially lifted. But we still expect the property sector turmoil will continue next year, which will pose a risk to the growth and also the financial stability for China. For Japan, I think the biggest issue is the currency depreciation that we have seen since this year. So the currency depreciation in Japan is mainly driven by the monetary policy differentiation between the BOJ and the Federal Reserve. And the Bank of Japan is committed to easing because they argue that the inflation is largely imported with limited pass-through to the wage or the core inflation. And in Japan, the recovery is expected to continue during the declining inflections, the strong domestic demand. So the last section in my presentation is about the policy advices we want to provide to the countries in the region. So first of all, we have seen that the fiscal and monetary policy have been tightened in most of the countries in the region, except for China and Japan. And particularly on the monetary policy, we see that the countries facing core inflation higher than target have already tightened their monetary policy, as you can see from the right chart. So it's actually very important for the countries to tighten the monetary policy in order to bring the core inflation back to the target. And the currency depreciation is another issue the region is facing. So our estimation based on the number this year shows that the rise in the inflation, the core inflation, has been driven by not only the input price, the shrinking output gap, but also the depreciation of the currency in the region. And we also estimated the degree of pass-through from the currency depreciation to the core inflation. We find that the region or the countries with a higher level of the inflation or the emerging market countries are facing the strongest pass-through from the exchange rate to the core inflation. But the silver lining, the good news is the Asian countries have stronger buffers against the FX pressure than the previous stress periods. So if you look at the current account balance of Asian Pacific countries, the advanced economies in Asian Pacific countries have particularly strong current account balance. They're mostly negative. And also if you look at the foreign currency reserve, most of the countries, including Asia's emerging market and advanced economies, have improved their FX reserve since the taper tension period. So that allows the Asian Pacific countries to defend against FX pressure. And on the fiscal policy, we know that countries are facing limited fiscal policy after COVID. And one of the reasons is that the debt has been rising, the sovereign debt has been rising in the past 15 years. And it has been further stretched since COVID. And the countries, for the countries in the region, fiscal consolidation is also required to stabilize the debt. And more fiscal effort will be needed if the interest rate were to rise even further. But that means some of the fiscal space might be further crowded out, and the country has to redesign some of the fiscal support measures to be more targeted, maybe temporary, and also maybe budget neutral. And at the same time, particularly emerging market countries in Asia has to come up with a credible medium-term fiscal framework. We also see some vulnerabilities in the corporate sector. Maybe my colleague Alex will talk a little bit later in his presentation. So we see that there is an increasing share of the corporate debt held by issued to those vulnerable firms in the past few years. And the market seems to be discriminating against those vulnerable corporates in Asia Pacific. And if you look at the corporate spreads of those vulnerable firms, the high yield corporate spreads, it has been spiked very fastly in the recent year. And it has been particularly the case for Asia's property sector. And also with the US monetary tightening, we're expecting that the vulnerable firms, especially the firms with a high leverage, will suffer more. So let me conclude with the policy priorities when the region, especially Asia Pacific, is facing the very difficult trade-off between supporting the growth, lowering the inflation, and also maintaining financial stability. So for the fiscal policy, we suggest the authority to consider temporary, targeted, and also in some cases budget neutral fiscal support measures to those vulnerable population. And the authority should come up with a credible medium-term framework to stabilize the public debt and rebuild the fiscal buffers. And for the monetary policy, we suggest authorities to tighten the monetary policy as long as the core inflation is above the target. And especially when there's a second-round effect pass through to the core inflation, meaning that the energy price or food price pass through to the recent inflation. And we also suggest authority to let the exchange rate adjust to reflect the fundamental. And in some cases, with some conditions, maybe the FX side, the FX intervention or the macroprudential policy may be needed. And also, the authorities shouldn't overlook the importance of the structural policies that will take care of the scarring effect that my colleague will talk about in a little bit, and also to support the green transition or climate finance. So with that, let me stop here. Thank you very much.
thank you both, Dr. Sang Ha-yu and Dr. Hee-Ji Seo. So we heard from the two speakers about the world economic outlook and then the regional outlook. So we have about 20 to 25 minutes. So let me get some questions for the speakers, and then after collecting a few questions, we'll take turns and then in answering the questions. Okay. Can a microphone be available? Okay, raise your hand if you have questions after. And okay, Kang, please.
Thank you very much. Got a few questions to the IMF speaker. I think China and Japan is quite a big two outliers in this region. So I think your IMF fund suggestion policy prior suggestion is based on their including those two big outliers. So I think what if we have exclude those two countries, and then maybe your policy suggestion is somewhat different. So that's my first the curiosity, and I think first of all suggest three headwinds. I think the Russia-Ukraine war and also the lockdown in China is be okay with me, but it seems to me the financial tightening is not the headwinds. Looks to if anything, these are measures, to higher inflation, right? So the claiming that the financial tightening is the headwind, I don't buy that. I think something like that. So I think there's curiosity over there, and so that leads me to the question of your downside risk to the outlook. There's pick up the deeper slowdown in China, global recession, and tightening financial conditions, and I think again this is kind of duplication of my assertion that deeper slowdown in China is an extreme outlier in this region. So the question is this, but at the end of the day, so China and Japan is now they decrease interest rate, instead of the other countries is try to raise rates. Then what's the implication of that, to the region, So that I'm very curious, very much curious, and also I think you stressed on core inflation pretty much. But this morning I read the Paul Krugman's article that he claimed that the question about the credibility of core inflation because of a used car, So after the Ukraine global supply chain disruptions, the perception of core inflation somewhat changed to include other factors to impact the core inflation. Let's say, so Krugman suggested trimmed inflation, something like the average trimmed out, average type of trend line, instead of the core inflation. So I would guess pretty much too much focused on core inflation, somewhat misled you to their policy suggestions. That's my comment. Okay. Thank you.
Thank you, Dr. Kang. Okay.
Yes, a very simple question to Dr. Seo. Is there do you see any possibility of upcoming economic crisis? Any types of crisis, of the countries in the region or outside of the region? Yeah.
Okay. Yeah. Why don't you let Dr. Seo to answer the question first?
Yeah, a number of questions. Thank you very much for all these questions. The first question is about the region excluding China and Japan, and we also document a number of these issues in the report. I think these three headwinds that we have in the report, that also applies to the region outside of China and Japan. Actually, this tightening of the financial conditions, that's especially the case for emerging market countries, even outside China. and also the Russian-Ukraine war that's affecting the commodity price, which is also affecting the region's net importers of the natural resources or the commodities. And we also have this China slowdown because China is so embedded into this supply chain in the region. So that will also have the implications for the regions. So that's why we also focus a lot of issues for the region, the Asian Pacific region, excluding China and Japan. I think the policy support, the policy advice that we have in the report is actually also applying to all these countries in the region. And the second question is about the financial conditions, why this is a headwind for the region. So I show some of the charts in the presentation, and if you look at the tightening of the financial conditions, that's actually quite substantial. But you're right, the level of the financial conditions, especially the yield, the sovereign yield, it's pretty much similar as the countries were experiencing before the pandemic. But we also noticed that there might be some divergence of the risky assets and the safe assets, or risky countries and safe countries in the Asian Pacific region. So one chart I showed is that the high yield bonds, the high yield corporate bonds, seem to have a very high premium, which means the market is actually pricing that high risk into these kind of risky assets in the Asian Pacific. And this might imply that for those risky corporates, if they try to issue the new bonds, if they try to secure funding, it might be very difficult for them. So that's actually the tightening of the financial conditions we want to describe. I forgot the crisis. Oh, the crisis. So it depends. Depends on whether we're talking about Asia Pacific. So because this presentation is about Asia Pacific, so I would just focus on Asia Pacific. I think for Asia Pacific, the risk of recession or the risk of crisis is still quite limited, given that we have seen so far. Even with the headwinds, we did a simulation for those kind of three headwinds combining all together and what's the impact on the growth, and that's about 1% GDP growth loss, which means the growth rate for next year is still going to be positive. So, in my point of view, I think that the risk of recession, the risk of crisis will be very low. And the other reason is that the Asian Pacific countries are having quite strong buffers against, for instance, large FX depreciations or some of the financial stability risks. So I don't see a very strong risk to the crisis, risk of crisis coming forward.
Okay, thank you. So if we can calculate any of those numbers excluding China, Japan, do you have any numbers on your head, or if you remember any numbers excluding? I mean, it's traditional to divide Asia to A, ZENI, and ZEN, but as he asked, if we include China, Japan, what is the average number for Asia? I mean, that'd be kind of interesting to know.
Yeah, that number should be in the World Economic Outlook.
Okay.
But we also, if you look at the core inflation contributors, we also have one chart that shows the contributions to the core inflation for the region except for China and Japan. Yeah, so that's also in the presentation.
Right.
Yeah. But we also see that the rising food price, the output gap, the exchange rate are contributing to the core inflation, even outside of China and Japan.
Okay, yeah, thank you. Yeah. And then for the question about the crisis, I got the weekly emails from Nomura, and they say they're listing 7 countries in the world as a potential crisis nation, and then for Asia, Pakistan and Sri Lanka, and on the border, maybe Turkey are the ones in Asia, potentially. That's as of this morning from Nomura, but you can tell. Maybe you're getting the same newsletter yourself. So, okay. So, any other questions? Yeah, please.
Thank you. I have one question for each of the presenters. So you might have this for the KIEP forecast. You might have this question already a month ago. But why is the forecast lower than the IMF for the overall global economy? And I realized that the the forecast for the U.S. is lower than the IMF's October's predict forecast. So is there any reason that your forecasts are slightly lower than especially for compared to the funds? And the other question that I'm having for the funds is, whenever you talked about the foreign exchange intervention, you said that as let the exchange rate float, but the exchange rate intervention if needed. And I'm really curious about do you have any rationale for this when needed? So now the Korea and Japan intervenes, but I personally think it's really low. The level of intervention is low, and whether you have a discussion within your team.
Okay, yeah, Dr. Yoon first, okay.
Okay, actually, it was a big relief until you have question to me, because I thought that I will not have any questions from the audience, because you guys already know what we have done until now. But let me rephrase your question first. So your question is why our number for US economy for next year is lower than the number from IMF, right? So first one is that our North American team has a conservative view for the US economy. That's the first one. But actually, what I thought is that for the US economy, actually, we see that their monetary policy is stronger than maybe the IMF is thinking about it. So nowadays, the asset market is responding very quickly whenever they have numbers from the United States. For example, when we see inflation rate as of 7%, something like that, then they change the expectation for the monetary policy. But our thought is that that's not how it works for the monetary policy, because the commitment of the Fed is a conditional statement. And even if we see that the commitment is changing every time, as the Powell says something during May and during November or something like that, but it seems that 7% is still very high. And we expect that the inflation rate will be lowered down, will not be lowered down until at least mid next year. And it is very hard to reach the inflation target until that time. So that's why we have a little bit more conservative view for the United States. And the second one is that this is also related to the stance of the monetary policy of the United States. And when we see the numbers for labor markets and the retail sales, which is a huge part of the U.S. economy, for the retail sales, when we check the numbers, it's still very high trend, it's above the trend. So when we see the high numbers for retail sales, still we have very high pressure for inflation from demand side. And of course, that will cause the inflationary pressure for the wage too, because we look at the numbers of vacancy rate 1.8 per unemployed person, so it's still very high. So from both of the side, and wage side, and when we see the retail side, we still see that the inflationary pressure is not going to be eased easily. So that might be the answer for your question for why we have numbers which is lower than the IMF.
Okay.
Thank you.
Okay, thank you. Yeah, explain in terms of the labor markets and the retail side. Of course, we will hear much more about the Black Friday resale in a couple of days, so it will be interesting to see, okay? And then Dr. So?
Yeah, so
I think you worked in MCM, right?
I work for MCM.
So maybe you have heard many times about if needed, so.
Yeah, so on the FX side, so I think our policy line is the country should float their exchange rate in order to reflect the fundamental, because we thought that the shift in the exchange rate is kind of like a shock absorber So whenever there's a depreciation of the currency, or whenever there's a pressure on the currency and the depreciation in the currency will absorb the shock. But at the same time, we also have the policy line that the country could consider, in some cases, they could consider these FXI or the macroprudential measures. That's also in our slides. So what's a condition? What's a precondition? One of the example could be that when the monetary policy, when the depreciation is so severe that the monetary policy become ineffective. And the other is that, for instance, the financial markets become disordered, and for instance, some of the corporates or the corporate sector has very high FX debt. And then the depreciation will cause some of the risk or turbulence in the financial markets. And in those kind of cases, and we would recommend, if there's some, in some cases, we would recommend that FXI could be used. But we don't see that in Asian countries that this FX debt is so high that could potentially cause the turbulence in the markets in the very near term. Yeah.
Okay, thank you. Yeah, if I repeat what his last page, it said, let exchange rate adjust to reflect fundamentals, period. FXI and MPMs may be needed to contain stability risk. So that's the official view, and I'm pretty sure, I don't know when you joined the fund, it changed a lot since the global financial crisis, so, okay.
Yeah, we're evolving.
Yeah, so, okay, thank you. And then, yeah, here's one more.
So are you guys actually using the integrated policy framework as a quantitative norm? And is that going to be the baseline whenever you assess the actual Asian Pacific countries? Is that so? And so I'm wondering whether you have actually that discussion within your team. I mean, I all agree on your statement basically, but yeah, whether you assess the actual realization of intervention.
Mm-hmm. Yeah, the IPF, the Integrated Policy Framework, that's actually something that's very new coming out of the IMF, and I think this kind of policy lines is actually what's coming out of the IPF. And we thought that floating exchange rate, that's a shock absorber. But at the same time, the other measures, including the FXI and the NPM, that should be also considered in some certain circumstances. And I think that's also coming from the IPF. Yeah, thank you.
Yeah. I mean, as we chatted over lunch, the former APD director is now at the helm of the Bank of Korea, and then he cares a lot about the IPF, and then Bank of Korea staff is working on it as well. So I'm sure, yeah, MCM people will have a lot of questions about the IPM. So, okay, any other questions? So, can you say a few words about the core inflation and other issues, whether that's how much of a concern when you're to the global forecast? Yeah, Dr. Kang talked about the core inflation versus other measures of core, like TRIMs and so forth. If you have any experience on your global forecast regarding inflation choice, yeah.
Actually, we don't give specific numbers for inflation and the idea for regarding the inflation or monetary policy. You two are the actual expert for this research area, so I don't have many things to say about it, but I can say something about the inflation differences across countries, because when we see the breakdowns for inflation for each country, for example, wage pressure is very high in the United States. On the other hand, for example, in South Korea, the oil price or commodity prices has a big role in increasing the price level. So depending on the situation across countries and heterogeneity, I think we have to rethink about the monetary policy framework in a sense that, because somehow we may have to change the monetary policy theme or even monetary policy target, because the growth rate trend over the last 30 years it seems that it's going to change a lot, and the trend is going to be changed, or there might be a structural change. So maybe we have to think about the target range between 3 to 4%, for example, for some of the countries. And that might happen in South Korea too. So that's what I can say for the question.
Okay, okay, thank you. Anything about core or that you're done enough for the core inflation? Okay. I mean, core inflation was introduced to this policy arena mainly due to the comment by Alan Greenspan when he mentioned that core PC inflation is the measure he's looking the most, as well as the non-farm payroll. And then maybe now it's time to look back and then see how each measure perform. And then, as you are all well aware of, many different regional banks of the Fed system are looking at different measures. And then I'm sure after this COVID is over, then we'll have a chance to look back and then just decide on what is the appropriate one for the Fed and for others in the world. Okay, we have about 5 minutes left, and then any more questions? Okay. If there is none, then let me use the chair's privilege to ask. So if I look back, Dr. Yoon, you showed how much of the 2022 forecast has deteriorated for the year and a half. And then absolute size is about more than 1.5 percentage point, almost close to 2 percentage point. If I look back, the 2020 forecast, I don't have the KIEP forecast in my hand, but if I look at my own slide for the IMF World Economic Outlook forecast, 2020 growth rate at the bottom was minus 5.2%. That was in the June issue of the WEO, and then it ended up having 2.95. So, but if I look at like a year horizon, it's almost moved up about 2 full percentage point. So if I look back now, deterioration of 2022 forecast versus improvement of 2020 forecast, right? 2020 forecast was improved. If I say one thing, it could be a vaccine, and then of course monetary policy. So what do you think is the main cause if I summarize one or two factors of 2022 forecast?
So when we have a forecast last year, and the main theme was like after the COVID-19 or after the Delta mutation has been decreased, then we thought that the government should have a role in investing for the long-term growth, for example, for IT-intensive industries or for green tech industries, something like that. So we emphasize the government role in raising the growth rate, because it was actually right time. We think that it was right time to transform our economy, because we have to think about the sustainable growth in the long run, rather than using a lot of fossil fuels or something like that. But that broke down right after the Russia-Ukraine war, and then that limited our eyesight right in front of us. So we don't have many rooms to look at, for example, look at the 10 years later from now. Rather, now we have to focus on dealing with inflation, war, cooperation and conflict, something like that. So that's more urgent one nowadays. So that's why we cut numbers a lot relative to the size of increase when we have done the forecast last year. So yeah.
I see. Okay, yeah. Thank you. So supply chain issue is,
of course,
affects not only on the inflation side, but on the real side, that's a factor.
Yeah, right.
And then you mentioned coordination and then maybe that's probably why you guys have the last word in the title, fragmentation was
that's right.
The lack of coordination. Okay. Yeah. So for when you experienced from the Fed about the 2020, you say you joined the Fed fund in 2018 before COVID. So if I look back 4 years of your own fund experience, how would you characterize 2020 forecast versus 2022 forecast?
Yeah, so there has been a number of events since COVID. We have COVID in 2020, and then we have the recovery in 2021. And 2022, there's a war in Ukraine. So we are actually keep adjusting our growth forecast. If you compare that with even before the pandemic, you see a very large scarring effect, which my colleague will talk a little bit about. But even after the COVID, we have different adjustments in the growth forecast. And even within 2022, we have different adjustments. As I just presented, Asia Pacific entered 2022 with some resilience. We see the first half of the year was quite strong in terms of the growth performance because several factors, strong external demand and also the reopening of the region except for China. And then after the war, and then we see these kind of three headwinds are materializing, which is affecting the growth negatively. So there has been a number of events in the past 2 or 3 years, and then we'll keep moving our adjustment forecast.
Okay, thank you, Dr. Seo. Any last question? If not, then yeah, please join me in thanking the two presenters.
So this marks the end of the session 1 about the world economic outlook, as well as the one of the Asia Pacific. We're going to have a really short coffee break. It's going to about for 10 minutes. The conference will resume at 15:22 sharp. Thank you again, and stay tuned with us until the end of the session 2 as well. Thank you. Welcome back, everyone. We're gonna, start straight to the session 2. It will be covering the business cycles and the firm activities. It is composed of 2 parts. The presentation will come first, and the panel discussions will follow afterwards. The moderator is the Professor Chang Yong-sung from the College of Department of Economics at Seoul National University. So I'll leave the floor to Professor Chang.
Yeah, thank you. First of all, I would like to thank KIEP and IMF for hosting this wonderful event and giving me an opportunity to sit here. So we have 2 very interesting papers today. Each presenter will spend 20 to 25 minutes, and then we will go to panel discussion. Each discussant will spend 5 to 10 minutes, and then we will open the floor. So first paper is Debt and Post-COVID Scarring, Global Firm Level Dynamics, Alexander Gobstey from IMF. And then second paper is Global Firm Dynamics, Trends and Changes After the COVID-19, Professor Yoon-Soo Lee from Seogang University. During the presentation, we will go down and then we will come back at the panel discussion. Right? Thank you.
Right, thank you very much for the kind introduction, and thank you to KIEP for hosting us. It's a pleasure to be able to join today, and particularly to be able to join in person. So I'm going to present joint work done by a large team in the Regional Studies Division of the Asia Pacific Department at the IMF as part of our latest Regional Economic Outlook. So first of all, I'll provide an overview of expected scarring in Asia and rough estimates of the contributions of different channels. Then I'll dig into each in turn with a focus particularly on the investment channel and the impact of non-financial corporate debt. I'll end by discussing policy responses to mitigate scarring with a particular focus on the potential role of digitalization in increasing resilience. So first, an overview of expected output losses after the pandemic. So, as with many other institutions, we measure these using the percent deviation in GDP in 2024 between pre-COVID World Economic Outlook projections and the latest round of projections. As you can see from the chart, we find large expected output losses through 2024, with average losses for the world economy of about 5.3%. Losses, as you can see, are easily largest for Asia at about 9%, with Africa coming in second with expected losses of about 6%. Those patterns are robust to using projections from other forecasters, as well as to using average growth from 2015 to 2019 as a benchmark instead of pre-pandemic projections. This large scarring effect in Asia is driven mostly by the emerging and developing economies, where expected output losses are 11% on average compared to 5% elsewhere. In contrast, losses for Asian advanced economies are much smaller and expected to be similar to those in other regions. So within Asian emerging markets, these relatively large losses are driven by 2 particular types of cases. The first is tourism-dependent economies like the Pacific Islands, the Maldives, and Thailand. And the second are countries with particularly stringent lockdowns, such as India and the Philippines. Now, on the right-hand side, we can see once again that these results are robust across different types of forecasts, and also when using the deviation from historic growth rates. So it's not simply that the forecasts for Asia were particularly optimistic. So to attain an illustrative decomposition of these output losses, we use standard growth accounting methods. So taking a Cobb-Douglas production function Output growth is composed of growth in employment, growth in capital, and growth in TFP as standard. We can calculate each element of those using both pre- and post-pandemic forecasts. We take projected output and employment growth from the World Economic Outlook, and then we project capital stocks forward using World Economic Outlook forecasts of investment and assumptions on depreciation rates using the perpetual inventory method. Then TFP is simply the residual. And what we find from these illustrative decompositions is that employment and capital each make up about a quarter of losses and TFP the other half. Now, given the difficulty accurately forecasting capital stocks and the fact that investment can also impact TFP growth down the line, the impact of lower investment could well be more than that quarter that we estimate. Indeed, investment as a share of GDP in Asia, as you can see on the right-hand side, is expected to be about 3 percentage points lower in 2024 than in pre-pandemic projections, a much larger fall than in other regions. So this decline in investment is what we'll focus on next. So what can explain the forecasted large decline in Asia in investment, especially when compared to other regions? So clearly some cyclical factors could be at play, as we've heard in the previous session. So heightened global uncertainty, the global rise in interest rates, and associated tightening of financial conditions. But given the particularly large impact in Asia, we think that structurally elevated non-financial corporate debt could also play a significant role. So in the literature, high corporate leverage has typically been found to be associated with lower levels of capital spending, as highly leveraged firms find it more difficult to finance subsequent investment projects. As we can see on the left-hand side here, the current crisis occurred in a context of historically high non-financial corporate debt across Asia, much higher than in other parts of the world, especially in Asian emerging markets. Now, while corporate debt was high to begin with, it also further increased after the pandemic, as we see on the right-hand side. So the increase has been particularly large in Asian advanced economies and emerging markets, rising by about 6% of GDP on average between 2019 and 2021, and that's likely to contribute to a weak recovery in investment going forward. To make matters worse, the increase in corporate debt has been concentrated in industries that were worst hit from COVID, such as consumer services and transportation. In contrast, less hit industries like pharma, biotech, semiconductors recorded a contraction in their debt levels over the same period. That divergence is starker in emerging markets than in advanced economies, which is intuitive, reflecting lower capacity for government support to struggling industries. So given these elevated levels of corporate debt, especially in vulnerable industries, we ask, could high corporate debt lead to a reduction in investment following recessions, thus amplifying the expected scarring effects? To answer this question, we look backwards and employ a large and rich firm-level panel database at quarterly frequency. We have data from 2001 to 2020, covering 75 countries, about 24,000 firms, for a total of over 800,000 observations. Empirically, as you see on the specification on the slide, we'll use a difference in difference local projection approach to see whether the decline in investment following a recession is larger for firms with high debt than for firms with low debt. So our dependent variable is the log change in capital expenditure over different horizons for firm N in country I at time T, and our independent variable is the interaction between the recession dummy R and a debt dummy D, which takes value 1 for all high debt firms. Now, how do we define those high debt firms? We take simply those whose average leverage over the entire sample is above the industry median. Then we include a stringent set of fixed effects to control for both country industry trends and firm dynamics, and firm characteristics. In a further extension that you can see at the bottom, we then examine whether the effects are larger for firms that are themselves more financially constrained, which we can proxy for using firm size, profitability, or debt composition. Turning to the results, we find that recessions have a large negative and persistent impact on firm-level investment in the medium term, and that this effect is especially larger in highly indebted firms. So on the left-hand side, we can see that investment in high-debt firms declines by an additional 2.5 percentage points within 4 quarters at the beginning of a recession, and that this effect increases to over 5 percentage points over 12 quarters. Looking at the green dots, you can see from early data on the impact of just the COVID pandemic, we find that the impact is more than 2 times larger than in historical recessions, possibly due to the high level of corporate debt heading into the crisis and the large magnitude of the shock. To quantify the magnitude of that effect, we can use back-of-the-envelope calculations, which suggest that firms' debt accounts for at least 28% of the average medium-term decline in investment following past recessions. On the right-hand side, we then explore the heterogeneity of this effect and see that the effect is particularly large for highly indebted firms that are smaller, less profitable, and have a higher share of short-term debt, which likely reflects difficulties in securing external funding due to a lack of collateral, limited internally generated funds, or difficulties rolling over debt. Now, in the interest of time, I'll just touch briefly on the implications of reduced labour inputs, and then I'll move on to TFP and policies. So, in advanced economies, the contribution of labour to scarring is mainly driven by a lower population, as border closures brought migration to a standstill, clearly, with large impacts on migration-dependent economies like Australia and New Zealand. In emerging markets, the main driver, in contrast, is lower labour force participation, reflecting worker disengagement and greater economic dislocation. Now, looking ahead beyond 2024, we could see further impacts on both the quality and the quantity of the labour force. So on quality, lost education from school closures is expected to reduce human capital, particularly in low-income countries. On quantity, fertility has fallen, particularly in countries with stricter lockdowns and larger economic losses. So the right-hand side chart shows results from looking at major epidemics over the last 2 decades using a similar methodology to with investment, and we find that there's, on average, persistent declines in fertility of about 2.5%. So given these potential losses, policies are going to need to try and boost all 3 drivers of growth. On investment, debt restructuring and reconfiguring insolvency frameworks to limit zombification of firms is likely to be particularly important. On labour, there'll be a need to invest in catch-up schooling to mitigate learning losses. And then on TFP, there could be a whole range of different policies. But for today, I'll focus on encouraging digitalisation for 2 reasons. First, there's substantial room for improvement. But second, there's also been significant recent progress, particularly in Asia, upon which the region can build. Now, obviously, there are many different ways to measure digitalization, but taking internet access as an initial version, on that metric, we see that Asian emerging markets and low-income countries have substantial room to improve, the low shares on the left-hand side. That's likely to be particularly relevant for post-pandemic scarring, as over the pandemic, industries have become increasingly reliant on digital infrastructure. So that's from micro-enterprises selling food on delivery apps to white-collar organizations transitioning to hybrid work. And indeed, turning to the right-hand side, we do see simple positive associations in the data, which we can then investigate more rigorously in our analytical work. But first, we also note that Asia has improved digitalization rapidly in recent years, accelerated by COVID. So on the left-hand side, looking first at the red squares, we note China's very high e-commerce share of GDP and relatively high shares also in Korea, in Japan, and in Indonesia. Turning to the bars, we also see rapid growth in e-commerce during the pandemic, particularly in Indonesia, in Singapore, and in India. Moving over to outcomes on the right-hand side, we can again see an association between digitalization and mitigation of the negative effects of the pandemic. So more digital occupations, shown by the solid lines, particularly in the tech sector, were hit less hard by the initial pandemic shock and subsequently recovered more quickly. And that differential effect was particularly pronounced in emerging markets, shown by the gap between the red lines. Now, to assess the role of digitalization in mitigating scarring more systematically, we can initially draw upon the same data set as in the previous analysis on debt and use a similar methodology. So we use a local projection setup, this time looking at the differential impact of recessions on the revenues of firms in highly digitalized versus less digitalized industries. The key question at this point is going to be how we measure digitalization, the D variable on the slide, which is of course a somewhat nebulous concept with as yet no internationally accepted standard definition among statistical agencies. Our response to that methodological challenge is to simply use a whole range of different digitalization measures, which we find all show similar results. Our baseline is from Calvino et al. 2018, who construct an industry-wise measure of digitalization, drawing on cross-country data on ICT input shares, robot usage, employment of IT specialists, and the share of turnover which comes from online sales. In robustness checks, we also consider two different types of IT input shares from input-output tables, and also intangible asset shares from the same dataset of firm balance sheets. Now, in a second specification, we can also draw on recent data from LinkedIn. So our main outcome variable in this case is now the hiring rate, which is based on users adding new employers to their LinkedIn profile in the same month that that job was due to start. Then for our independent variable, we can measure digitalization by the relative frequency of technology skills among all skills listed by people who list themselves as working in a particular industry. Turning at last to the results. So on the left-hand side, we find that firms in more digitalized industries like software recorded sales 1.4% higher 2 years after past recessions relative to average industries. As we might expect, looking at the green stars, that's with the early data from the pandemic, and sure enough, we see a much larger effect so far, with sales 3 to 4% higher after 1 year. That's reflecting the particular nature of this particular recession, in which lockdowns and social distancing put a particular premium on being digital. On the right-hand side, turning to the results from the LinkedIn data, we find a similar effect. So hiring rates are 1.5% higher in more digitalized industries 2 years after the recession, and significantly more workers move into more digital industries, and significantly fewer workers leave them. So overall, we find evidence from a whole range of measures that digitalization does seem to correspond to lower scarring, both in prior recessions, but also particularly so in the recent pandemic recession. So to sum up, the region is expected to suffer significant long-term output losses after the pandemic due to declines in all three components. We find that investment reductions are likely to have particularly negative effects, both directly, but also potentially through reducing total factor productivity growth. On that basis, we support policy efforts to mitigate investment scarring stemming from higher corporate debt, as well as catch-up education to address lost schooling and hence the labour component. We also highlight, and in greater detail in the latest Regional Economic Outlook chapter, the potential for digitalisation to support resilience. So we also support efforts to increase digital connectivity, as well as to upskill groups with low digital literacy. So I'll end there and look forward to hearing from the discussants. Thank you.
Hello, I'm Yoon-soo Lee, and first let me start with thanking the organizers, especially the KIEP and IMF, for making such a wonderful opportunity to present and think about the changes after the COVID-19. The topic that I'm going to present about global firm dynamics, especially the trends and changes after the COVID-19. This is a joint work with Professor Dae-Soon Kim at North Carolina State University. And this project is based on the joint project with KIEP, with Dr. Sang-Ha Yoon, Dr. Yein Baek sitting there, and also Dr. Won-Tae Han. Okay. Oops. Sorry, I was too fast. Okay. So the global economy recently went through great changes after the COVID-19. In this presentation, out of many changes, we'll focus on the global firms, big firms, and we'll check what happened to them and what's the impact on the macroeconomics as far as we understand. The firm dynamics have been an important topic in macroeconomics recently, but mostly the current literature focus on the startup and growth of young firms because they are key to the long-run economic growth. So young firms are known to be an important factor in job creation and also productivity growth. So if in terms of long-run growth, the age of the young firm, age of the firms matters in, that's what we know in the literature. So the recent literature focus on the firm dynamics from the size measures to the age measures when you think about the growth of the firm. Okay, but more recently, the focus have shifted to the startup and startup deficit, that's the lack of the entry in the macroeconomy, and also decline in dynamism. So after the great financial crisis, there has been a growing worry about stagnation, that is the slowdown in the economic growth. And those studies find that the decline in the startup may be an important factor explaining the stagnation and also jobless recovery. So in this particular presentation, I'm going to focus on the global firms. So instead of the smaller firms or entering the firm dynamics literature, we will think about what's the role of large global firms in the macroeconomy and how have these dynamics have changed after two global recessions, so 2008 financial crisis and 2020 COVID-19. So there is a long list of studies on the growth firm, as I emphasized, but they are mostly on the smaller firms. But if we think about the aggregate fluctuation, large firms matters, and those small firms, because they are relatively smaller, have less impact on the macroeconomics. So that's one of the reasons maybe the recent interest in the macroeconomists have shifted toward larger firms, in particular, the concentration among larger firms and increase in the markups. So I think one of the important topics in the macroeconomics last 2 decades is probably the decline in the labor market, labor shares, and related to that topic, the increase in the average, the markups among firms. So this piece I draw from Jan Eckhouse, one of his papers and his plenary talks. So the average markups in the aggregate economy, if you look at in the left panel, the average markup has been increasing. And such an increase in the markup actually have been concentrated in the very top firms, like top 10% firms. And most of the action are coming from the upper half distribution in the, of the firms. So the lesson from this growing literature is that when you think about the aggregate fluctuation and when you think about the macro impact of firm dynamics, it's not just the small firms, but larger firms are getting more important. So this increase in markup occurred mostly on larger firms. Also, and they also find that these large firms are relatively less sensitive to business cycle. And more recently, people find that firms with higher markups are also less sensitive to the business cycle. Okay, so what we do in this work, what we present, is the result on the largest firms in the world. So we first select top 100, 250, 500, and 1,000 firms, global companies for 3 big economic blocks of the world. and we'll examine the changes in the concentration and profit margin for each block, so that are East Asia, North America, and Europe. So we'll examine the importance in the economy first in terms of output and profit shares for these firms. And we'll examine the profit margin in terms of cost-to-sales ratio. And we find there's some difference of this. And we'll try to look at the investment and R&D expenditure to check if these investment patterns can be a potential explanation of increasing the profit margins. And then finally, we'll look at the share of new firms in this top global firms list. So this is not entry or startup. These are the entry of large firms into the global top 100 firms list. So I think this can be an important margin of looking at the firm dynamics in the future. And that's, we are going to try to start looking at how these firms have changed. And when we look at these characteristics, we'll focus on the changes after the great financial crisis in 2008 and the COVID-19 in 2020. Those two time periods are marked in the vertical lines in the figures that we are going to see. And what we don't do here yet is we don't do any causal analysis. We don't even have a single regression in this presentation today. But we still think that there are more fundamental questions that have to be answered, which are the implication of such changes of large firm dynamics on the macroeconomy, how those can affect or shape of the growth of the macroeconomy. So overall, if I summarize the findings so far, is that largest firms became more important. So the world has been growing, and these largest firms has been a growing share of the growing pie in the global economy. And they also became more profitable in most of the regions. But still, there are some differences across the region. For example, North America is more dynamic in terms of the dynamic measures that we are looking at. And also, profit margin has been higher in the firms in North America. So overall, we believe that these more dynamics in North America are related to the sustainable or solid growth that the US economy or North America economy have observed in the last 20 years. Okay, the data we are looking at is compute step fundamentals. There are two different data sets. One is from North America, that it have about 41,000 public firms in USA and Canada. And the global compute stat, that's about 44,000 public firms that exclude, obviously, North America. That covers more recent cohort. And given that most large firms are public firms traded in the open public stock market, we think that the compute stat data set are representative sample of large public firms. And the key issue in terms of comparing those firms from different countries to each other is to make the units are comparable. So we construct real values in the US dollars using the IFS, International Financial Statistics from the IMF. So we can trust the source, obviously. So first we denominate in dollars and the local currency in dollars, and we also check the real changes over time so that the different inflation dynamics are reflected in the data. And then analysis starts from 2003 to avoid the sample, the additional samples are added to the data. So we'll start most of the research that figures that we are going to show today will be a baseline comparison or growth from the 2003 base year. And the largest firms, we select them using based on the variables such as sales or profit, and we use the average between two sample years. Okay, so first, let's start from looking at the dynamics of importance in terms of first revenue shares, and I'm going to show the profit shares. So it's normalized to 100 in 2003. And so for the first figures are East Asia, you can see the steady increase in the revenue shares in East Asia from 2003 to 2013, ranging from 100 to about 150. And in the middle, you see the North America. They have been increased, but kind of stable around 100. So they have an increase up to 120, but declined to the 100 levels on the. And for the European large firms, they have increased up to 2013, and they came back. Although there has been some spike after the second vertical line, which represents the COVID-19. So one noticeable finding in this figure is that for East Asia and Europe, top 100 or top 1,000, they show very closely, they kind of move together. But for the North America, the blue line, they show the top 100 firms are actually show the rapid and more dramatic increase, especially after just before and after the COVID-19 period. That's one thing that we can see. And if you look at the profit shares, for the profit, we use the OIBDP, operating income before depreciation and amortization, and we look at that shares out of GDP. And that has been increasing for the there has been dramatic increase in the East Asian large firms, that up to like 80% increase in the East Asian companies. And for the other regions in North America and Europe, that share has been relatively stable. Okay, so given that such an increasing share, so increasing importance of large firms, we look at what are the characteristics of these top companies. We will first look at the cost-sales ratio. So these are good alternative of measuring or estimating markups, but markup estimation is kind of cumbersome, but this one is kind of clear cut of just simple average of measuring the cost and sales ratio, and this one moves very closely with the markup or profit margins. And we'll show you that this cost-sales ratio or the profit margin are different across firms in different regions, and we'll try to explain whether capital expenditure or R&D differences may be also can be a proxy for to explain such differences in cost-sales ratio. Sales cost ratio. Okay, first, sorry for the magnitude, but differences in the magnitude that does not stand out in the figure, but note that the first sales cost ratio moved together with profit margin. Given that assumption, we see the overall increase in the sales cost ratio or profit margin around the COVID-19, and that increase is particularly stronger for East Asia. But if you look at the measures, we see that higher sales cost ratio in North America, that's about 1.35. So that means the largest firms in the US generate $1.35 revenue per 1 unit of dollar cost. So for unit of cost, unit dollar cost, there are 1.35 times of sales for the US firms. But that number is about the half for the East Asia. The number stood out at about 1.18, and also for the European countries, it stood out at around 1.2. So the profit margin was higher for North American firms. And if we look at the capital expenditure, actually that does not say a lot for the US company actually, because the top 100 company have relatively smaller share compared to the other largest firms in the US. But we see some noticeable, small but noticeable increase in the East Asia and actually decline in the European countries. On the other hand, if you look at the R&D expenditure, we see the steady increase in North America, especially dramatic increase for the top 100 companies that have been steadily increasing the R&D expenditure. So it can be a possible story that maybe economists have to look at further to try to explain the source of increase in the markup or profit margins. And so we still see the great increased trend in the East Asia, but the magnitude are only half of the US. So the R&D expenditure has been increasing in the East Asian company, but they still have a relatively smaller share of R&D expenditure compared to the North America. Okay. And finally, we will examine the difference in the pattern of these top firms' growth across the industry. So first, we know that East Asia is the factory of the world, and we know that the East Asia have higher share in manufacturing and growing share in impact. And North America, there has been the service sector has been more important in North America, and we'll see how these dynamics of largest firms are different between among these three different regions. So first, we look at the importance in terms of sales, the sales share of top companies. We are looking at various industries, so we picked a relatively small number of firms. We will look at top 10, top 50, top 10, 20, top 50, 100 instead of from top 100 to top 1,000. So one noticeable difference is obviously East Asia. In East Asia, the shares of these top 100 firms has been growing over time. So the share has been increasing from 100 to like 160. And such an increase has not been observed actually in North America. Top 110 firm shares in manufacturing has steadily decreased. They have been decreasing from 100 to 80 or 60% of the 2003 level. And in the European regions, top 100 firms have relatively stable shares remaining at around 100, but slow, a little bit declined, and they came back after the after the COVID-19. And if we look at the service sector, it shows very interesting difference again. So for the North America, the top 100 firms shares has been steadily increasing, and especially for the top 10 firms, their shares in the GDP doubled from before the financial crisis and after the COVID-19. And there has been some increase, not as dramatic as the North America, but European top 100 firms has been increasing shares in the service sector. But for the East Asia, the top 100 firms, which are shown in the blue lines, are relatively stable, while actually top 10 firms share has been relatively stable, while other top 100 firms have increased a little bit, expanded a little bit over time. So this figure shows that each region have different shares in the service sector and manufacturing. So while the manufacturing has been growing in the East Asia, large firms here has been growing. And on the other hand, when the service sector has been has started having increasing share of service production in the world, at the same time, top 100 firms in the service sector also has been growing more. So they're having greater share of growing pies over time when the industry has been increasing. So last piece of the figure that I'm going to present today is the ranking dynamics. So instead of looking at the entry and exit of small young firms or startups, we look at how this ranking has been changed for the top 500 or top 1,000 firms in the world. And we look at each region, and we see that this share of new firms into these top global firms has been increasing all the three regions, but that increase was particularly stronger for the North America. And overall, this entry to this top firms list has been higher for North America. So if we think about the dynamics in terms of these large firms, in the US and Canada, they have been higher probability of getting into the largest firms in the world. So, and overall, there has been declining trend of these shares in the East Asia and Europe. So that's kind of a sharp contrast to the US, although that ratio has been recovered a little bit after the COVID-19. So why this is important for the growth? So if we think about the startup and if we think about the declining dynamism, we have looking at the demographic factors, the workers are getting old, so there are less potential entrants in the world. But the growth potential is very important factor. So if you have a higher chance of getting becoming a largest firms, then the expected profit or expected prospect of startup are much larger. And if you have a higher chance of becoming like Amazon and Apple, then you are more likely to start a business and continue. But you don't have a very good prospect of becoming a very large profitable firms that you can play in the global market, then that gives a smaller prospect for the startup, so that will reduce the probability of entry. So that's the implication, I think, potential implication of this summary of the work. So if we summarize, we see that largest firm became more important. There are some differences across regions. And based on our finding, probably more research should be done to find the implication of larger firms. And one dimension will be the difference in the policy environment between the North America and small open economy or the emerging market, for example. So after Lina Kwan was appointed by the chairperson of the Federal Trade Commission, there has been a great shift in the antitrust policy in the US. But if we think about the view on the largest firms, in general, we emphasize the fair competition in domestic market. But such a situation may be different for the small economy and especially the economy with firms that have more global, that play in the global market. So there is a kind of recently growing view about such firms. So when they look at those firms, they look at in the perspective of national champion. And from this work, we have observed that growing economy, actually in the East Asia, we saw that the largest firms has been increasing share of manufacturing. And also in the US, when they grow, those big technology company has been increasing share in the service sectors. So this suggests the large firm dynamics and the view on the fair competition for the largest firms. We cannot look at those firms in the single view on the antitrust policy, but we have to think about in terms of macroeconomic growth, also for the overall growth of the national economy. Okay, so, and also in terms of ranking dynamics, we saw that the North America is not just more dynamic in terms of entry and exit rate and small firm growth, but they seems to be more dynamic in terms of the firms getting higher chance of becoming global players. So this is, I guess, a new perspective that we may look at on firm dynamics. So rather than looking at the small firms entry and exit, whether these firms can have a potential to become large players, may be an important source of explaining the startup deficit and declining in the dynamism. Okay, thank you very much for listening.
So for the panel discussion, the presenter will go and then the rest will sit here and then. So we have 4 discussants today. The first, Iji Su from IMF. Yeah.
Right. Thank you very much for this opportunity to discuss these 2 great papers. First of all, I need to state that the views expressed in this presentation does not represent the view of the IMF and this board. So let me start by saying that these are the 2 great papers that actually complement each other. So the way to think of this is by thinking the Cobb-Douglas production function, you have 3 components that drives the growth. You have the productivity growth, you have the the capital formation, which is related to the investment, and you have the labor markets. So the first factor is related to the KIEP paper by Professor Yi. So in that paper, the productivity is related to this R&D spending, the innovation, and the firm dynamics. And also the second paper, the paper from the IMF by Alex, seems to be related to the capital formation, investment, and the labor market supply, which is in that paper. So the IMF paper is on the corporate sector scoring. So what Alex found is, and the co-authors found is, that the corporate sector debt has sharply increased after or during the COVID-19 in Asia, which discouraged the corporate investment. And also it has the implications on the labor market. Lower labor input in Asia is related to the longer school closure and the decline in the fertility rates, which has a long-term implications for the labor markets. And then the KIEP paper by Professor Yi on the firm dynamics over the past 2 decades. It shows the heterogeneities in the market power of the large firms across the different regions, North America, Asia, and Europe. And it finds that the firms in North America seems to be more dynamic and more willing to invest in innovation by R&D, which is prone to the increase in productivity. So in the rest of the presentation, the rest of the discussion, I'll focus on the KIEP paper on the global firm dynamics. So let me journalize this paper by showing 3 main findings from this paper based on the data, the firm level data from the 3 different blocks of regions in the past 2 decades. First, there's been an increasing market concentration among the largest firms in East Asia over the period of 2003 and 2013. And second, the market power of the largest firms in North America tend to be increasing. The market power could be indicated by the profit margin or price markup. And then the third finding is that there has been an increasing capital spending or capital expenditure by the large East Asian firms, while at the same time there has been an increasing R&D spending by the North American firms. So why there's such a pattern based on the firm level data? And the paper seems to show 2 explanations. The first, there's a difference in the sectorial patterns. So what the paper found is actually the largest firms in North America are increasingly concentrated in the service sector, which requires R&D spending. But at the same time, there has been an increasing concentration of the East Asian firms in the manufacturing sector, which is capital intensive, and that needs more capital spending. But we know that the price markup or the market power seems to be more related to the R&D spending, which has been documented in the literature. And the second explanation is this kind of winner takes most dynamics. The paper finds out that there's an increasing share of the new entrants in North American firms. So North American firms are more dynamic. And these kind of new entrants seem to be more innovative and more willing to invest in R&D. And that helps the firms in North America to increase the market power. So that's what I summarized from this paper. But I have 3 comments for this paper. First of all, that's a question from me, is how large is the trend in East Asia captured by the Chinese firms? If I understand correctly, the majority of the firms in the sample of East Asia is coming from China, Korea, and Japan. And we know that if you look at the first chart here, which I plot, is that the total market capitalization of the public firms in China has been picking up very sharply over the period of 2003 and 2013, which is exactly the period that you see that the market concentration has been increasing for East Asia. And also, if you look at the largest 1,000 firms in the right chart, among the largest 1,000 firms in East Asia, the share of the Chinese firms by market cap has been also increasing over the period of 2003 and 2013. So then the question is, we see that the market concentration has been increasing in East Asia, and also those firms seem to be more willing to invest in the capital spending, not the R&D, which might be because the Chinese firms have been increasing in the market cap, and also the Chinese firms are more concentrated in the manufacture. And that's why we see that in East Asia, there's increase in the capital spending, not the R&D spending. And at the same time, because in China, the largest Chinese firms has a very high share of the state-owned enterprises. And the state-owned enterprises are usually more concentrated but less dynamic and less willing to invest in innovation. So, so the question is, how much we can differentiate between the Chinese firms and Korean and Japanese firms in your sample of East Asia? So that's a first comment. The second comment is, because the paper shows that the innovation seems to drive the market power. But the question is, do we have this, because once a firm has a market power, does that have the implications on further innovate? So this kind of reverse causality issue is the question I have. So, so if for instance, when the firm, if you think about the firm's innovation decision, when they have the market power, and let me rephrase in this way. So once a firm starts with a low market power, the firm has more incentive to invest in innovation because they want to get more market power. But once they reach some limits of the market power, maybe they have less incentive to invest, less incentive to invest in R&D, less incentive to innovate. So probably, conceptually, we're going to see this kind of hump-shaped relationship between the market power of the firm and their incentive to innovate. So the chart here on this slide is something that we have from our work in Economic Outlook in 2019 that shows this kind of hump-shaped relationship. So when the firm is starting from low market power or low markup, they increase their innovation, they increase their patents, but once they reach some limit of the market power, and then this kind of incentive drops. So the question from me is, do we see the differences of this kind of hump-shaped relationship across the regions? Maybe in the US, there are more incentive for the firms to further innovate, even they have the market power. And then maybe in East Asia or Europe, this kind of incentive is weaker. So maybe I think that's an interesting question to see this kind of difference and then relates to the government support to the innovation. And the second thing for this comment is, once the firm reaches some limits of the market power, do they invest more even for the capital spending? So the idea is that as a firm's market power increases, it can increase their profit by increasing the price because they have the market power, and at the same time reducing the output. And reducing output means they reduce the investment. So this is also, the chart here is also something we have in World Economic Outlook. So we find that the top decile firms, in terms of the market power, actually invest less. So does that actually explain why in the North America, because we have the chart in Dr. Yi's presentation, in North America, there has been a decrease in capital spending. So does this chart relate to what you found in your paper? Because in North America, the largest firm already has a market share, a large market share, a large market power, so they invest less afterwards. And then the third comment is something related to COVID. So how does the COVID change firms' innovation? Okay, so one thing I observed from all your charts is that this kind of, the average R&D spending shared by the top firms. And I found that East Asia is the only country that further increased R&D spending, even after the pandemic, I mean, to 2021. So what's driving this? So if you look at the other two regions, Europe and North America, actually there's an increase in R&D spending, but afterwards in 2021, there's a drop in R&D spending. So my question is, what explains this pattern? So in the paper, the R&D spending seems to be driven by two factors. One is, it depends on the sectors. If there's a shift of the sectors from the manufacturing to the service sector, and then maybe you will see the country having more R&D spending. But it doesn't seem to be the case in East Asia, especially after COVID, because there are also some charts in the presentation showing that there's an increased concentration of the manufacturing sector in East Asia, which cannot explain why we see the increase in R&D spending. And the second reason that could potentially explain this chart is maybe the East Asian firms are getting more dynamic. So if they're getting more dynamic, East Asian firms want to innovate more, want to invest more in R&D. But that also doesn't seem to be the case because there's also a chart that shows that East Asian firms are actually lower in terms of the dynamics than the other two regions. So I come up with this kind of idea that maybe the pattern here in this chart is related to the digital adaptation. That's actually related to Alex's paper. So we know that in East Asia, the digitalization has been stronger than the other two regions. And at the same time, because of these lockdown measures and reopening is a little bit later in East Asia than other regions. So the companies has to invest more in the digitalization. And if they want to invest more in digitalization, actually they have to invest more in the R&D spending instead of capital spending. So that might explain that in this chart, we see that this, the R&D spending by East Asian firms increased even after the COVID in 2021. So let me drill several policy implications that I generalized from this discussion. So first, we see that there's a sectoral shifts in R&D spending that's associated with increased market power, so and also the firm dynamics in North America. But other factors I thought would be also important for increasing productivity by increasing the R&D spending. So those could be the protection of the innovation, especially for the startup firms, so that they can become more dynamic, and also lowering the regulatory cost. And second, because of this kind of potentially higher market power incentives, the firms, they want to innovate more, but once they reach some limit of the market power, maybe they become less willing to invest in the innovation or invest in R&D. So what can policymakers do in order to incentivize the firms to further innovate, even they already have a large market power? So maybe they can cut the domestic regulatory barriers to entry so that firms can become more dynamic. Once they're more dynamic, then they have more incentive to innovate. And second, maybe the countries can increase the openness to trade and foreign direct investments to bring in the foreign capital and foreign firms to increase the competition. And then the final policy implication is that it seems the firms have become more dynamic since COVID-19, especially the East Asian firms. And this might be related to the digitalization. So the policymaker could consider some of the support measures for digitalization to further increase the innovation or innovativeness of the firms. Let me stop here. Thank you very much.
Okay. So next discussant is Sung-Hoon Lee from Yonsei University.
Okay. Thank you so much for this opportunity to discuss this research, and I learned a lot from this paper and my own preparation. Okay, so yeah, I'll focus on the IMF paper. So, okay, let me first summarize the, how can I go back? So let me first summarize this paper. So this paper claims larger expected outcome losses for Asian countries, the APD EMDs, Asian Pacific Emerging Market and Developing Countries, compared to the non-APD EMDs. So, and they decompose the channels into three ways, into three channels: a decline in investment, a decline in employment and labor force participation, and slowdown in productivity growth. And they also say the higher level of corporate debt may things even worse through the decline in the investment. And as a policy implication, they say the digitalization may be able to mitigate the negative shock, since some Asian APD EMDs have room to improve their digitalization. Okay, so I found this paper very interesting and very surprising to me, because I didn't even recognize Asian countries are more affected. So I thought about I thought about why APD EMDs are supported more than non-APD EMDs, but I don't really have a good insight. And so from this paper, I don't see much clear driving forces too. So the first question on my mind is that who are the APD EMDs and who are the non-APD EMDs? So according to the report, APD EMDs includes the China, Indonesia, India, Malaysia, Philippines, and Thailand and Vietnam. And non-APD EMDs are, Brazil, Chile, Colombia, Hungary, Mexico, and South Africa. So I'm not sure whether these countries are comparable groups, each other. So, and related to my previous question about the sample, So output losses here are defined as percentage deviation in 24 GDP prediction from the pre-pandemic projection. So this output losses here can be large if the pre-COVID trend is high or post-COVID trend prediction is low. So let me first talk about the pre-trend. Okay, so this figure, this table shows the average of annual GDP growth from 2010 to 2019, and the red ones are the APD-EMDs, and the blue ones are the non-APD-EMDs. So as you can see, I mean, the APD-EMDs grew up a lot faster. So if everyone has to stop during a race, and the fastest runner should slow down the most. So this, as the table shows, APD-EMDs were the faster runners than the non-APD-EMDs. Okay, let me talk about the post-trend. So the red lines, the y-axis is the annual GDP growth, and x-axis is the year. And the red ones are for the APD-EMDs, and the blue ones are for the non-APD-EMDs. Okay, so as I said before the COVID-19, the APD-EMDs show higher growth rate, but everyone slowed down during the COVID-19. But so it's not very clear to me from this figure, but APD-EMDs may have showed slower recovery than non-APD-EMDs. But there is some chance that APD-EMDs to rebound in the near future. So I have a question. Is 2024 the right time to measure the output losses? So that's one question. And this is about the digitization, and it's also about the driving forces. So even if APD-EMDs do not rebound in the near future, we still need to understand the driving force. So, when I heard about these larger output losses for the Asian countries, the first thing on my mind was China. So APD-EMDs may have slowed down due to the supply and demand shock in China. So if this is the case, this negative shock will not go away as long as the trade war between the United States and China continues. So in any case, it is not very clear to me how digitalization can alleviate the problem. So maybe APD-EMDs fall behind in other dimensions too. So there are many other ways to raise the GDP of the APD-EMDs, and it's not very clear to me why digitalization is one of the efficient way to boost the APD-EMDs. Okay, so that's it. And I found this paper very interesting, and it's a very nice work. And thank you so much for sharing your valuable insights with us. Thank you.
Okay, so next discussant is Woojin Choi from KDI.
Thank you. I'm Woojin Choi from KDI. Thank you for the opportunity to discuss the interesting paper. Usual disclaimers applies. And okay, I'll skip for the summary, the post-crisis situation. I'll go through very fastly. The author mentioned about COVID-19 pandemics and hampered growth, and the expected output losses are largest in Asia. And there's been an investment slump, lowered investment rate, especially combined with the corporate debt. And there also is a labor market disruption, which could possibly be problematic in the long run. So my first comment is about the investment slump. So whenever there's an investment decreases, that's going to be a first order worrisome for many policymakers. I agree with that. But another thing that came to my mind that I've been thinking why the consumption to GDP ratio has been so low in Asia, and then especially the Korea, the high investment before the 1997 East Asian crisis. So it's been told that there's an over-investment, especially before the 1997. And whenever people talked about the saving glut, it's not about the discrepancy between the high saving rates and the investment rates, but the overall level of the investment was already very high at the time. And it's been mentioned by many people, Prasad, Sir, and some colleagues in the institute already also mentioned the low consumption to GDP shares in Asia, especially in Korea. So it's really nice to see that the investment has been lowered. It's very interesting to see that investment ratio has been lowered in these East Asian countries. Especially, but I don't think this decrease in aggregate investment rate itself is a intrinsic problem for some people. It could be a way to a new next stage. Like many people already have noticed, this high saving rates, even higher saving rates than the investment rate, was an issue, was a question. It's not easily be accounted by the simple neoclassical rationale. So it can be a bad thing. It can be it might be a losing investment opportunity in Asia. But at the same time, this is my calculation based on the World Bank WDI simple calculation, the unweighted average over the region. And you can see that gross fixed capital formation, the percent of GDP has been dropped after 2017 or something in these East Asian countries, but still very high compared to the other regions. So it's even higher than some other regions even ever reached during like a Western Hemisphere or something. So, and of course, it's also the gross saving rate is even higher, but it's also decreasing. And if you think about the growth perspective for Korea has been stepped down gradually. So, and still we have very high consumption ratio. Very low consumption ratio. So possibly we need think about this more carefully. So that's the first thought. And then moving to the next one, digitalization and the policy. So I read it very interestingly, the digitalization and recovery. The manufacturing sector, especially the information and communication technology, seems to have played a key role in recovery, and that's I believe it is almost consensus at this moment. Like Korea, Taiwan, these semiconductors industry had a large export booms during the 2020 and 2021. So that's in some sense, the results is consistent with many people's prior. But I also the discussion raised to my mind, what if we evaluate the analysis after 2023? There's a large drops, especially big techs in Nasdaq or something. The drops in already the realized revenues and the expected revenues in the information and communication technology. So that's the first comment. And the other one, so the title of the section was the policies for the post-COVID-19 crisis. So okay, the digitalization could be nice, but how? And if you think about that, there's many. The author has mentioned a lot of this from the policy side, but I always think, okay, this digitalization could be possibly good, but how we can implement the further digitalization, more the investment in this ICT sector, that's going to be a real problem for policymakers. And first, is the public sector better in intermediating capital to most productive firms? So is public sector have a superior ability to figure out which firm is going to be more promising in the future or not? So that's one thing that comes up to my mind. And the other one, the fiscal policy. So this is I always think that there's a little it's also been mentioned at the first session, but already with the very high public debt, it's really difficult there's a little room to will these fiscal policies. This is from my own work. So this is the negative correlation between public bonds to total assets and the corporate loans to the total asset from the bank's balance sheet side. So whenever government tried to do something and they raise the And if they do not decide to raise the tax, they have to borrow from the investors. And that might crowd out the corporate loan to the, from the bank balance sheet side. And then this is from my own result, the loan registry data. So I construct the corporate loan bank space. And as you can see, the public bonds to total asset increases of the hypothetical matched firm is the strongest predictor of the investment slump in Korea. So what I'm trying to say here is that whenever government tries to do something and they try to raise the public bonds, it might very easily could crowd out the bank's loan to the private sector. So again, digitalization might be good, but it's always difficult to figure out how we can implement this in a fiscal side. All right. Lastly, I have some minor comments. So the results is based on the quarterly data, and I presume that then it's a sample of large firms already, because small and medium firms cannot usually do not report the quarterly data set. I'm not sure which data set you used. It's but my presumption is that the small firms are dropped from the sample, so true investment slump will be even larger than what's been reported. And some other minor comments. You distinguish the high debt as an indicator based on the average leverage over the entire sample period. But it's also been very widely noted, reported that this leverage, the debt level and the investment is very highly correlated. So there might be some endogeneity problems. So like the Chapman's paper recently published in Journal of European Economic Association, they used this indicator for high debt firms, high indebted firms, they construct this indicator based on the period before the actual event. So that could be another issue, the small issue here. So this is, again, I enjoy reading this article. This is interesting and timely analysis. It's very elaborate work, I personally think. Somehow you have to fit this into the regional economic outlook fit. So there's a little bit of, I'll say, a jump. But if it's going to be a paper, I think it's really going to be a very, very solid one. And again, relevant policy issues going to be more difficult because in the actual implementation, there's many hurdles. So that's my comments.
Thank you, Dr. Choi. The last discussant is Dr. Han from KIEP.
All right, thank you so much for letting me serve as a discussant for this renowned and important IMF regional economic outlook, which always contributes to the academic circle and economic practices. So let me briefly summarize the main idea of this paper, and then I want to discuss how the insight and main findings, main analysis of this paper in the context of the Korean economy. So this paper is motivated by the observation that output losses are expected to be more persistent and severe in Asian area in compared to the other countries. Like, so you can see this the second bar, which extends to the bottom, and which stands for the Asian countries, in compared to African countries and Middle East and Central Asia countries, and Western Hemisphere and European countries. So this is the 2024 output projection, calculated at the time of 2022 in compared to 2020. And the author decomposed this dismal outcome for 2024 output losses into three components. One is capital accumulation, Second, the employment. Third, and TFP residuals. So the author found out, wanted to suggest one channel for lower capital accumulation and the other channel for lower employment to explain what is special. Why do we have this lower 2024 output losses in compared to for the Asian countries in compared to the other regions? So the first channel is investment scarring in Asia, and the figure on your left shows that the non-financial corporate debt for the Asian emerging market developing economies have accumulated more than the rest of the world. And also, advanced economies in Asia also have accumulated higher debt, corporate debt, in compared to the rest of the world. And the paper shows that the decline in investment is larger for those firms that are smaller in size, less profitable, and with a higher share of short-term debt. And secondly, they show the other channel, which is important for the lower employment, that is decline in labor supply, and the first figure shows that Asian Pacific emerging market countries have stricter school closures in compared to rest of the world, and this pattern is more pronounced in the low-income developing countries for the Asia, which is green bar, and in compared to the rest of the world, which is red bar. And so what would be the policy remedy to mitigate this investment employment scarring? So first, they provided the solid evidence that firm revenue in more digitalized industries are higher, and which can be a solution for investment scarring through digitalization. And secondly, they show that industries which is more digitalized are hiring more, which contributes to the employment improvement. So I want to discuss how this insight and idea of this paper to the Korean data in the context of the Korean data, Korean economy. So the external debt problem in Korea is the problem not only for non-financial corporate sector. You can see since the 2019 quarter, the fourth quarter, the blue line stands for the long-term external debt. The red line stands for the short-term debt. You can see that non-financial corporate sector accumulated more than $20 billion since 2019 for the long-term debt. And also, you can see for the banking sector, they accumulated a long-term debt as well as short-term debt. And the government the same pattern goes for the government, the external debt of government. So the high leverage problem is significant not only for the non-financial corporate sector, but it also acts as the problem for the banking sector, which tightens the financial market conditions in Korea and adversely affects the fiscal space for the Korean government. Secondly, I want to show you the famous quarterly firm level data set, which is KIEP's value, to show you the effect of pandemic was very asymmetric across industries. The left figure shows that the red line stands for the pandemic, the path during the sales path during the pandemic crisis. The blue line shows the global financial crisis case. Even though the global financial crisis shows you the deeper and more prolonged depression in compared to the pandemic crisis from the KIEP's value data, I found that the adverse effect of the global financial crisis on the firm level, on the Korean firms was almost equally adversely affects almost all industries, but there were winners and losers in the case of pandemic. So on the right hand side, I aggregated up the firm level data over contact industry and non-contact industry. You can see there's huge difference between contact industry sales pattern in compared to the non-contact industry. I went into more deeply. I separated all the industries. I show you here. I show you the sales path, sales deviation from the average of 2019 over the time path. So first, the main takeaway is there were winner industries and loser industries, which was different because almost all industries the sales was depressed during the global financial crisis, but during the pandemic, there were winners and losers. And for the red line stands for the agricultural and forestry and industry, and you can see that in compared to the 2019 average, the sales was depressed by 20%, and the mining industry has actually the increase in the sales during the path of the pandemic. And on your right, you can see the transportation industry, the green line transportation industry was heavily damaged during the pandemic. And interestingly, on the left, in the bottom, you can see that the real estate and renting industry get very high sales growth in compared to the 2019, which reflects the bubbles in the asset market in Korea from the housing market. And lastly, on your right, you can see the sales was severely damaged for the art and sports and recreation industry. So from this observation in the context of Korean economy, I want to, for the future study, I want to see how the medium-term effects after we separate the cyclical components from the structural components, like the idea of this IMF paper. It'll be interesting to see medium-term effect of the pandemic on contact sector and non-contact sector. And also, it'll be also interesting to see the medium-term effect on each different industry based upon the Shoreline pattern that I just showed you. That's all for my comments. Thank you so much.
Okay, thank you. So why don't we give presenters opportunity to respond quickly, and then we will open the floor. So Alex, you want to go first?
Sure,
yeah, yeah.
Right, let me start by thanking all the discussants. That's a really outstanding set of comments, and you've really gone into a lot of detail, so really appreciate that. And I won't be able to cover everything in the short time, but I look forward to continuing the discussion afterwards. Let me go through quickly and chronologically through what we've just heard. So the first thing that stood out from Ija's presentation on the other paper, the thing that sprung to mind for me was this idea of factoryless goods-producing firms that Teresa Forth at Dartmouth has been talking about. So I was wondering whether the increase in R&D and markups and profits from the US firms and the reduction in, and the increase in investment, but without increasing profits in the East Asian firms could be two sides of the same coin, where essentially it's Apple designing in California taking a large markup, while a producer in Eastern China then has to increase investment correspondingly, but isn't able to have the market power to increase profits. So it'd be interesting to see the GVCs being brought in to link those two findings together. Moving on to Professor S. Lee. So really liked the analogy of the race. I thought that was great. So I definitely take the point that there's a mechanical element there. I think it's interesting. It slightly depends conceptually what we mean by scarring, right? So if we're talking about, do you fall behind the other runners in the race disproportionately, then yes, of course, the faster you were going before, if everyone stops, then they catch up more with you. If instead what we're thinking about in the race is you versus your personal best, you versus the amount of growth you might have had, then nonetheless, you are having a larger hit. And so your potential output that you might have achieved is reduced more. So it slightly depends conceptually what we mean by scarring. And I agree, the relevance of the comparison depends on what our definition of scarring is and what we're trying to capture. On the solutions, I thought the idea of maybe if this is a China shock, then digitalization doesn't help was definitely an interesting challenge, which I think has some merit. I would say that for most economies in East Asia, one of the nice things about digitalization is it's something that you can influence. It is under your control more. Most Asian economies aren't going to be able to influence China's rate of potential growth. If we think that there's a slower rate of potential output in China over the medium term, then most countries are not able to influence that with their policy. Also, as a couple of people highlighted, so this is now moving on to Dr. Choi, certainly we're not claiming that digitalization is a panacea. In the paper, we list a whole range of different policies. So I wouldn't want to imply that we think it's some kind of cure-all. Investment being high in the region as a whole, such that potentially reduction in investment is no bad thing. I think that's a really interesting point. I think for me, we would have to disaggregate the region a lot more there. So I think most people will sort of agree that there's a very high rate of investment in China historically, therefore potentially a move towards a more consumption-driven economy is beneficial. Other countries, I think, potentially a very different story. Digitalization and the role of the state. So as I said, not a panacea. I think I'm perhaps slightly more optimistic about the potential for the state to have some role. I think at the base level, addressing the digital divide is something where the market is not going to seek out people in rural areas with low digital skills and help them get connected if there's not a substantial profit to be made. I would point to India, and we see lots of papers coming out of the fund recently on the successful digital schemes in India, things like the national biometric identity system linked into payments infrastructure and so on. So this kind of digital infrastructure can be pretty important and well provided by the state. It was the capital IQ, yes, so mostly large firms. They're slightly smaller than the global firms in the second paper. All I'll say on the last piece on the correlation between loans and investments. So there's a companion working paper out now which goes into a lot more detail and provides a lot of robustness checks. So yeah, see that on the point about the particular way to define high debt firms. Then lastly, Dr. Han, really interesting to hear all those various, all that detail and really rich color on the Korea-specific case. The thing that really stood out to me was how striking the relative hit to sales was in high contact industries. I thought that was really fascinating to see just how stark the particular impact was and really highlights the heterogeneity. So I think as we take this work forward into the paper version, really exploring that dimension of heterogeneity is going to be very interesting. And I will leave it there. Thank you.
Thank you. So, Yunsu?
Thank you very much, Dr. Lee So, for the actually fantastic summarization. I like his version of summarization than my own. And also very insightful comments. I mostly agree with you. Actually, just before I came to this floor, I was talking to one of the ex-KIEP member who is an expert in Chinese economy, and we kind of talk about how this Chinese firms has been growing and how that are related to the policy actually heavy subsidies during the booms that probably have led to the increase in the investment in the boom time and also the subsidies so that they were able to survive during the hard time. Actually, I don't know, it'll be very interesting to see how this policy or even without the policy, how this growth in the Chinese firms have been affecting or reshaping the competition in the largest firms in terms of production. And most of the comments I agree, but except for the, I mean, it's not that I don't agree, but just a small comment. I kind of think Alex also pointed out is that whether markups are leading to higher markups are leading to smaller R&D. Actually, that's because I guess it's the firms in the U.S. and the firms in the China are in the have different position in the global supply chains. Actually, so the U.S. firms like Apple, they are more like designing and research intensive. So R&D are more important for them, while the firms, the production side that are mostly done by Chinese firms, actually in terms of production, maybe capital intensities are more important, and which I think lead to the important policy implication for the growing emerging economy, I guess. There is this, there should be obviously the transition from manufacturing to the service, and also the repositioning or kind of going up in the supply chain. And if they move to the service, or they go upstream in the supply chain, actually R&D is becoming important, but a lot of emerging markets development policy or industrial policy are more focused on the capital expenditure, I guess. So that's something that we may have to think about together. Overall, I truly thank you for the very insightful comments. You really helped me. Thanks.
Great. Why don't we take one or two questions from the floor, if there's any? Jinil? Yeah.
Thank you. A quick question for each presenter. For Alex, I'd like to know as a takeaway, how much digitalization could affect. So in terms of relative amount, in terms of, say, after COVID, we lost, and then relative to that, like a quarter or half, or how much does it affect? And especially if you decompose the labor effect versus the output effect, that would be fantastic, because labor productivity could go up for either reason, and digitalization itself could be a trend. So we all agree that contactless culture changed a lot, and these days, especially in the US, a lot of big tech firms are adopting different technologies and different commuting. Yeah, so I like to have a rough number or benchmark number would be great. And for Yoon-Soo, you carefully said that carefully noted that your analysis is not causal but only causal, but still, I'd like to push you a little bit about how we think that, the Alex's presentation has the graph of that slightly as well, but whether the big firms innovate or the surviving firms turns out to be big, and then your description of that causality, or how much of that is purely the effect of the big firms. I'd like to have your view on that as well. Thank you.
Okay, any other question? Okay, so, yeah.
Thank you for your great presentation. And my question goes to Dr. Kopsteak. There's a lot of heterogeneity, of course, even in Asian countries, as you know. So if you would confine your sample to countries in which manufacturing sectors are the share of the manufacturing industries are very high, such as Korea, Japan, or China. And then your conjecture might be different for your analysis. And then the other thing is that for Korea, among East Asian countries, a labor force decline is very dramatic relative to even with other Asian countries. So that might give us a different result of the analysis if you confine your sample size only to Korean economy. And the other question is that you have used the Indeed or LinkedIn to analyze the labor market in Asian countries. I don't know, and I'm not sure if that is going to be the representative sample of representative sample for Asian countries, because I actually rarely see that people are using LinkedIn or Indeed when they try to find a job or when they post job vacancies or something like that. So my questions are, those two. Thank you.
Okay, so let me abuse the power of being a chair by asking question to each presenter. So to Alex, you shown that there's investment decrease by, especially by financial constraint firm. I'm wondering whether there's also, you can see employment drop by financial constraint firms. And also in terms of scarring effect, you mentioned the school closure, but at the same time, for the labor market entrants, they lost a lot of opportunity during the COVID. And not only because the labor market is frozen, also they don't have enough opportunity to interact with their seniors and learn stuff. And the question to Yoon-soo is that you define the top 10, top 100, and these definitions are all across industries, I guess, not just industry-wise concentration. Then I'm wondering, there's a composition issue here because US, a lot of top firms are financial firms or let's say IT-related firms. But then in Asia, probably many of them are like manufacturing. Then there's an asymmetric effect during the COVID period, right? So the Microsoft, Google, Amazon, they did well during COVID, and also financial firms. But then manufacturing firms, they suffer. So I guess there's an issue of composition effect just because it's a unique recession. Okay. Alex, you want to go first?
Sure, thanks a lot for the more great questions. So starting over here, so the size of the digitalization effect. So in the paper, we're finding that it reduces the reduction in revenue by about 2 to 4%. So it's not huge, but it's about comparable with the additional badness that having high debt is. You know, being more digital has additional goodness of a similar kind of order of magnitude. Obviously, as you noted, varies a lot by country. I think the really interesting thing that we weren't expecting going into the project is, everyone is very convinced that digitalization is great in the long run, right? We all think of it as increasing your TFP. No one would support an economy which is not trying to improve on that dimension over the long run, and we think it leads to long run growth. So, whereas what we're finding is that in the short run, in downturns, it's actually making things less bad, which we didn't think was obvious. So that's a sort of additional reason on top of all the other reasons you would like those technologies. I think I missed a bit on what the particular Korean sample case was. I think in the companion papers, we do go into the particular subsamples a bit more. On representativeness, I would say absolutely. I am very sympathetic towards the case about the extent to which LinkedIn is representative. And I actually have another paper on India where we deliberately don't use LinkedIn. We use a particular Indian platform because we think it's much more representative. What I would say is happening in this case, we use both LinkedIn and Indeed, and essentially we're trading off, having access to some sort of high-frequency data, which is able to give us something better than these balance sheets, which have a long lag before the corporate earnings are released. But of course, in exchange for the higher frequency, we're probably sacrificing something on representativeness, so very sympathetic to that view. On employment, so unfortunately we can't observe it. It's a classic thing that with these balance sheets, they're not legally obliged to state employment. I agree, it would be really interesting to see. And then finally, on your labour market effects piece and the lack of interaction with seniors, so it's a good point. I didn't mention that channel. We don't really talk about it in the paper. Personally, as someone who joined an organisation at a time when I was able to start in person, incredibly helpful. My seniors 1, 2, 3 years ahead of me who had to start virtually, I think it's a completely different experience. And I do think that as time goes on, we'll only see it more in the data, just how negative that particular channel was. So I think it's a really good point. Thank you.
Thank you very much for the good question. First, in response to Jeannie's question, whether these are the causal, actually, I think it's causal, but whether it's sufficient condition, I'm not sure, because not every firms that are spending a lot of money on R&D and investments are successful. But for those exposed successful, we know that they were spending a lot of research and a lot of money on the R&D and the investment. So this is probably causal, but it's really difficult to know, because some of them who are really working hard are not always successful, unfortunately. And about the Chair Yong-sung's question, we define top 10, top 100 for the whole sample, actually for the entire region. So obviously, except for the analysis that are done for each industry. So as you all pointed out, there is this composition issue. So for example, exactly the same argument that during the COVID, these pharma kind of firms have increased the sales, then the characteristics of the firms are actually overrepresented by the increase in the composition of those firms in that particular industry. That's the caveat of the analysis. I agree. Right. Thank you for pointing that out. Okay.
Right. So before we close the session, let's thank our staff from KIEP to run the whole thing today, and then also let's thank two great presenters and four excellent discussants. So this will close the session. Thank you.
So this marks the end of the entire 12th KIEP and IMF Joint Conference. I hope this fruitful discussions be the benchmark for the benchmark reference for the next year's economy. And thank you for the viewers online who stayed with us for the entire conference. Thank you very much, and I wish you all happy holidays in advance. Thank you very much.